watching All About Stocks on ET Now. Thank you for staying with us. Prakash Devan is with us in the studio as well. And we're going to quickly go on to his second recommendation this week. He's recommended Spanco Limited. Take a look.
Spanco Limited is a part of the Spanco Group and creates technology infrastructure for power companies and telecom service providers. The company also operates BPOs in India, Africa, and in the Middle East. The company's profits for the March quarter fell 11% from a year ago. High debt on the books resulted in higher interest costs, which ate into the profits for the quarter. However, operating margins improved 14% year-on-year due to lower raw material costs. The group as a whole continues to face liquidity issues because of its high working capital requirements. Consequently, the promoter of the company has pledged about 86% of his shareholdings in order to raise loans for the company. The Spanco stock has fallen about 55% in the last year.
Alright, so that's possibly a new stock most of us have not paid attention to in the past. The company's profits, like that story was telling us, were down in the last quarter. There's a lot of debt on those books as well. But it's available at very good valuations, isn't it?
Absolutely. In fact, Spanco is a struggler at this point in time. And the reason I chose this was it's been a struggle for the last 18 months or so. In fact, the promoters have gone ahead and pledged a significant quantity of the holding to actually repay a lot of debt that they had earlier raised on. What's happened is the company has undergone a major shift in terms of its business focus. Earlier it was depending a lot on the government side of the work, which was related to e-governance. What they've done is they've moved into a lot of system integration on the power sector. That's also not paid off. They do have a couple of BPOs. They have a domestic BPO business. They run the IRCTC BPO business, which is very interesting. All these years it's been actually running along without any profits because they could not arrive at a significant business model, revenue model that could pay it. Now they finally come to an arrangement with the IRCTC where it actually starts paying off. And when that does, it's going to be a blockbuster. So that's one component that I'm definitely banking on. And you also have some of the telecom service providers for whom system integration work is done exclusively by Spanco in a way which is a monopoly of sorts. And, given the fact that you need higher efficiency levels to recover the high cost of being in telecom, all these players would be forced to depend on vendors like Spanco. And that realization is something that's now kind of setting in.
If I'm a retail investor looking at Spanco at all, give me a cap of my portfolio that I should look at and not invest maybe more than 5% or whatever.
Well, not even that much. This is a stock that you gradually build into. This is what forms this is a spice element that could do well in the portfolio and pay off handsomely, but you can't overdo it at the same time. So maybe a couple of 2-3 percentage points of your portfolio is good enough.
What are your targets on this stock?
I'll be slightly reasonable, though my estimation is about 145 rupees in another 12 months' time, which sounds very optimistic, almost like doubling from here on. I would expect it to be in triple digits at least in the next 8 to 12 months.
Two recommendations. We talked about Reliance and we talked about Spanco Limited. We have a couple of quick questions before we wrap up. Krishna Lakshmi has written in. She wants to know the meaning of price to book. Can you take her through that?
What typically it means is how many times, what is the multiple that you're paying for the share's book value. So if you actually look at, let's say, Reliance, the book value is, the market price today at 700 would actually be lesser than the book value. If you look at the book value, it's derived from the value of the assets that the company has.
Quality assets that the company
so that's the company asset value, and the price is a multiple of that. So in certain cases, if it's closer to 1, you're not overpaying for the stock. But if it's huge in terms of a multiple, if it's 2.5, 3 times, that means you're paying much more for a stock than the asset value represents. But a P by BV ratio of 1 is just ideal. Anything less than 1 is attractive.
We have a question from Shankar Narayan. 500 shares of Ranbaxy, which he bought at 532. He wants to know, should he exit at this point? Ranbaxy ended the week at 487. Strong results in the last quarter. Business is expected to grow by nearly 30%. What's your call on Ranbaxy?
I think it's a hold. He'll definitely get better than that 530 that he's bought into. In fact, Ranbaxy is going through a reversal of sorts. We've seen it being sideways for a long time. It's now that it's coming of age. And there is a premium attached to the stock. There should be a better premium attached to the stock than what it is. And I think definitely it's going to be above 530 very soon.
So hold on to Ranbaxy. Unfortunately, we've run out of time on this show. Remember, you can send in any question you might have about your equity investments, even if you just want us to explain something to you. You'll also find this show on our Facebook page, and you can reach me on Twitter. Prakash, always a pleasure to have you on the show. Look forward to having you back soon. Thanks for watching. Bye-bye.